Thank you very much. Well, it's great to be able to present here through the wonders of the modern world. This paper is about the relationship between monetary policy, inflation, and unemployment as enshrined in the famous Taylor Rule, and it's joint work with John Steinson and Venance Roulier. So John Taylor published his original paper on a very simple formula describing what the Fed did in 1993. And as many of you, working in a central bank, I'm sure know, the paper has by now achieved what I would call mythical status, enshrining this concept of the Taylor Rule. My guess is that the people in this Teams room have probably collectively, being people at central banks, seen thousands of variants of the Taylor Rule. John Taylor's 1993 paper was mostly descriptive, though he did observe in 1993 that the years he studied from 1987 to 1992 were years in which you could say that the conduct of monetary policy was generally good. So he suggested that this rule should also perhaps be viewed as representing good policy. We're going to think about both questions. First of all, the extent to which the Taylor Rule is descriptive. So how well does it describe what central banks actually do in the modern world? And second of all, the extent to which the rule is prescriptive. In other words, how well does it describe what central banks should do in the modern world? So now let me get into the details. Even if you know the Taylor Rule, as I'm sure that almost all of you do, you might not sort of know the details of what was in the paper. I don't think I did until we wrote this paper. So he published his paper in 1993, and the original paper actually analyzed 6 years of data. So those years were 1987 to 1992, and that's what I'm showing you on this slide here. And the figure here, it shows that the fit of the Taylor Rule is incredibly good for these years, 1987 to 1992. It's also worth reminding you of the context of the paper in terms of economic history. So 1993 in the United States, the Fed and many other central banks around the world had just come off some very difficult decades for monetary policy. And of course, this is true also of Israel. So the years around 1980 were years when inflation was really high in a lot of countries. And so, in a lot of countries, including the United States, many other countries around the world, the reputation of the central bank as an inflation fighter was, to say the least, very limited. So in the United States, the Fed's reputation as an inflation fighter was very much new in terms of whether people trusted it to be able to keep inflation down. And there's no question that inflation expectations at that time were almost completely unhinged. So let me show you a picture to demonstrate that, because this is something that's changed pretty dramatically. Here I'm showing you long-run inflation expectations. So that's the red line, along with core CPI inflation. That's the blue line. And what I want to contrast is what this picture looks like at the beginning versus the end of the sample period. So this goes from the late 1970s to the present. And you can see that in the early part of the sample period, the blue line, so that's, the red line, which is 10-year ahead inflation forecast, like I said, tends to move almost 1-for-1 with actual core inflation. So, if actual core inflation falls by 1%, the 10-year ahead inflation forecast is falling by almost the same amount. And keep in mind, this is the time period in U.S. history, which is probably the most famous for political pressure on the U.S. Fed chair. But in the late 1980s, around 1998, there's this dramatic shift where long-term inflation expectations almost completely stabilize around 2%. And then you see that the red line was just incredibly stable, even during the Great Recession. So that's, this period here where we can see that there was a big drop in core CPI inflation, but really nothing happened at core. And then the most dramatic example of this was during COVID, when inflation went up to, 7 or 8% in the United States. But nevertheless, really not much happened to 10-year ahead inflation expectations. And this is very different to what happened in the 1970s and 1980s, when not only did inflation itself rise, but long-term inflation expectations also rose dramatically. So what I want to emphasize about this picture is this dramatic difference between the beginning of the sample period, when longer-term inflation expectations moved almost 1-for-1, with inflation itself, to the end of the sample period when, during COVID, inflation shot up to 7 or 8%, but these long-term inflation expectations barely budged. So this is a dramatic change. So now going back to the Taylor rule, on the first slide, I showed the fit of the Taylor rule on the 6-year period that John Taylor emphasized from 1987 to 1992. And that's the gray line in the slide here. Okay, so this area here. But if you look outside that window, so this is expanding, the graph to a much longer window, you can see that the fit is quite a bit worse. So here we're trying to be as faithful to the original specification as we can. We're using the same coefficients as Taylor did and the same measure of inflation. But the only changes we make here are to use the Fed's Green Book measure of the output gap, because you really can't use the kind of filtered measure that Taylor used on this short sample period over a longer period of time, and to use real-time data. If you use retrospective data, current data, the fit is quite a bit worse. So here's a somewhat better fitting version of the same rule. So not massively different, but a little different. So the change I'm making, so I'm showing you the equation up in the right-hand corner here. This is the original Taylor rule with the coefficient of 1.5 on inflation and 0.5 on the output gap. Here I'm showing you something that Janet Yellen referred to as the balanced approach. It's one of the Taylor type rules or interest rate type rules that the Fed still looks at today. And this rule places a weight of 1.5 on inflation, just like in the original Taylor rule, but it puts a weight of 1 instead of 0.5 on the output gap. And I'm showing you this rule because this is one of the versions of the Taylor rule that fits the best over a longer time period. And in particular, it fits somewhat better than the original Taylor rule. So aside from putting a somewhat higher weight on the output gap, there are 2 other changes relative to the original Taylor rule that I'm making to make this graph look a little bit better. First of all, I'm allowing R star, the natural rate of interest, to vary. So we set it at 2% until 2012, and then we let it decline afterward with the median value implied by the Survey of Economic Projections of the Fed, which is, long-term projections presented by the Fed at the time of some FOMC meetings. And as before, I'm using real-time data. So the key idea with the real-time data is really about using real-time measures of the output gap. And when does this matter? It matters particularly in the late 1970s. So there's a lot of discussion in the academic literature about the idea that the Fed in the late 1970s, so again, this is the time period when inflation in the United States got completely out of control, but also in many countries around the world. And it turns out that for the United States, you can understand the behavior of the Fed during this time period through the lens of the output gap reported by the central bank. So if you look at what the central bank said the output gap was in the late 1970s, they were much more optimistic about the natural rate of output, the natural rate of unemployment, than later the Fed, thought it was. So this is why using the real-time data makes a big difference. And you can see, actually, perhaps surprisingly, for some of you who may have thought about this time period, so this is the time period that many people say in the United States was a big mistake with monetary policy. You can actually see that if you used the Fed's real-time views about the output gap, it lines up pretty well between this interest rate rule, this balanced approach rule, and what the Fed actually did. But that is because the real-time data say that the Fed had this very optimistic view about the output gap at that time. And this helps explain, the dovish policy of the Fed in the late 1970s. So I want to point out 3 things in particular about this picture. So first of all, the rule obviously fits pretty well during the period that Taylor studied. But it also fits pretty well throughout the entire Greenspan period up until around 2008, so up until around the financial crisis. But then it doesn't fit at all well during the Volcker period, so that's the early 1980s, when actual interest rates in the United States were much higher than what the Taylor rule would have prescribed. And it also doesn't fit well, basically, since the Great Recession. So, of course, it doesn't fit well during the ZLB period, but it also doesn't particularly capture the liftoff from zero interest rates, the timing of the liftoff, or the magnitude of the liftoff. And then finally, as I sort of indicated before, the largest deviations on record from the Taylor rule are during COVID. So during this period of time, the deviations from the Taylor rule are on the order of 10%. So these are, extraordinarily large deviations from the Taylor rule. And in some sense, this was the motivation for us working on this paper. This was a period when a lot of, people in the private sector and in academia, naturally asked the question, well, there are these huge deviations between, what the Fed is doing with policy, what a lot of central banks were doing with policy, and the Taylor rule. Does that provide, just really obvious evidence for suboptimal monetary policy? So as a sort of side note, I imagine that some people in this room feel that they've seen better fitting Taylor rules over shorter periods. But I want to emphasize that here we're looking at the same coefficients over a very long time period. So you can make things fit better by re-estimating over a shorter time period and sort of moving around the constant terms and so on. But it's not clear how well a rule where you really had to update the constant term or the coefficients in every time period will fit out of sample. So we sort of constrained ourselves to focusing on rules and looking at them over long periods of time. Okay, so that was the United States, but now I want to show the rest of the world. So now I'm showing the Taylor rule and actual policy rates for Germany up until 1998, and then the Euro area, Japan, and the UK. So the blue line is actual policy rates, and the red line is the original Taylor rule. And the dashed line is a re-estimated version of the same kind of rule. So in other words, the dashed line is sort of trying to give the Taylor rule the best chance to fit the actual policy rates. I'm not showing Israel in these pictures. We actually did analyze or we included Israel also in our figures. We don't have it. We don't have it here, but perhaps I'll mention it a little bit later on. But I'm sure you all know that data much better than I do. So for the most part, in the countries that I'm showing here, the Taylor rule fits worse than for the United States, except for in some isolated time periods like the UK in the 1980s and the 1990s. You can see that the Taylor rule fits, somewhat well during this period. But as a general matter, the Taylor rule implies dramatically more volatile interest rates than what we've actually seen. So, for example, if you look at the case of the Euro area or Japan, actual policy rates in blue have fluctuated much less than the Taylor rule would prescribe. And from this perspective, monetary policy has been what you could call very passive. But we also know that, inflation did not take off in these countries over this time period. In particular, if you think about the Bank of Japan, which is one of the graphs here that looks most dramatic, during this period of time, you see much more volatile actual rates implied by the Taylor rule than actual interest rates. But yet inflation for most of this time period was substantially below the Bank of Japan's target. Now, some of this difference probably arises from the fact that we don't have as good measure of the output gap for these countries than the United States. So as I mentioned earlier, we used the Fed's Green Book measures in the United States, but here we use a filtering approach. So some of the difference probably arises from that, but I don't think you can attribute the whole difference to that. And again, the largest deviations on record happen in the Euro area as well during the COVID inflation surge, where the deviation is on the order of 10 percentage points. Okay, so now let me zoom in on that episode where there were these, in some cases, really huge deviations between actual interest rate policy and what was prescribed by the Taylor rule. So here I'm plotting the response of 8 central banks during the COVID inflation surge. And this illustrates the huge amount of heterogeneity in the responses. So the G7 countries that I was discussing earlier all reacted very slowly and gradually to the COVID inflation surge. So this is what I'm showing you here in red. But other central banks around the world, these are shown in blue here, like Brazil and Chile, responded very quickly and very forcefully. So there was this huge amount of heterogeneity in how different central banks responded to COVID. And in our paper, we divide the COVID inflation surge period into two halves. You can think about the early period, 2021 and the first half of 2022, versus the later period, the second half of 2022 and 2023. And we contrast countries that we refer to as early risers, which raised rates more in the first half of this subsample, so 2021 and the first half of 2022, versus countries that we refer to as late risers, who raised their policy rates more in the second half of 2022 and 2023. So the G7 countries I discussed earlier, the Euro area, Japan, UK, and the US, they're all examples of late riser countries. So countries who raised their interest rates much more in the second time period, from the second half of 2022 to 2023. But there were a lot of other countries in the world that raised interest rates much more aggressively earlier. So the early risers are depicted on the left side of these graphs, so the first column here, and the late risers are in the second column. And then I have two variables here, so this policy rate, so the interest rate in the first row, and inflation in the second row. So what this picture is showing, first of all, if we focus on the policy rate, is that the early riser countries, they not only raised their interest rates earlier, so that's how we define them, of course, but they also raised their interest rates by more. So the early riser countries raised their interest rates by roughly 9 percentage points versus something like 4 percentage points in the late riser countries. So just according to sort of a simple analysis, if you were thinking about this in the context of undergraduate economics, you might have thought that the late risers, because they raised their interest rates so much later and by so much less, that they would sort of pay for it in terms of higher inflation. And of course, there were many of them, including in the United States, that were criticized for being behind the curve. But what's surprising, if you look at the second half of this panel here, so you look at inflation in the early risers and the late risers, is that they actually didn't pay a price in terms of inflation, at least if you look at these kinds of simple measures. So the bottom row shows inflation for the early riser versus the late riser countries. And you can see that even though they had this very aggressive interest rate response in the early riser countries, the early risers actually had a stronger surge in inflation, and that this surge in inflation was also more persistent. So that's what I'm showing you in the lower left-hand graph here, than the late riser countries, which I'm showing you in the right-hand graph here. So again, the point I'm making is just a very simple, argument just about correlations. You see, by definition, these early riser countries raised their interest rates earlier. As it turns out, they also raised their interest rates by more. At the same time, you actually see that they had more inflation and more persistent inflation. So in fact, the early riser countries saw, inflation peaks, on the order of 11 percentage points, whereas it was more like 6 percentage points in the late riser countries. So why is this, right? It sort of seems backwards from at least the simplest macroeconomic analysis we might consider. So I think there are a lot of things potentially going on here, but this right-hand side graph provides some insight into what might be going on. So on the x-axis here, we have average inflation over the 3 decades preceding COVID. And on the y-axis, we have interest rates at the beginning of, the increase in interest rates at the beginning of the COVID inflation surge. So in the first half of the sample period that I talked about, so 2021 and the first half of 2022. So what this is showing is that there's a strong upward sloping relationship between the two variables. In other words, the countries that had the most checkered inflation histories, so countries that had had high inflation in the recent past, so a country like Brazil, also chose to raise interest rates much more aggressively during the COVID inflation. In contrast, countries like Japan or the United States, who had had multiple decades of low inflation, ended up raising interest rates by substantially less. But they also, perhaps felt that they had the freedom in some sense because they had this very long history of low and stable inflation to do this without worrying about inflation expectations becoming unhinged. So in contrast, perhaps countries with these more checkered inflation histories worried that, given what people had seen in the very recent past about high inflation in these countries, that if the central bank just didn't respond to high inflation, inflation expectations might become unhinged. And I looked at this a little bit before the presentation. I think Israel is basically on this, close to the regression line here on this graph. So, one interpretation, like I said, I think there are multiple things going on, but I think one interpretation here is that credibility plays a big role. That, countries that had this very, long history of low and stable inflation also had very anchored longer term inflation expectations, and therefore were able to sort of look through the high inflation during COVID, look through the supply shocks and so on, without seeing inflation expectations become unhinged, and as a consequence, without seeing a larger inflation response. So to summarize, yes.
Yeah, we have two questions from the chat. So the first question is, why doesn't the Taylor rule match during COVID period or outside the US? Is it a change in central bank objectives? Is it something else?
Yeah, that's a great question, and very much sort of to the topics I'm going to address next. So I think we are going to argue that, in fact, there are in some sense good reasons for central banks to deviate from the Taylor rule, at least in periods or conditional on a very strong anchoring of inflation expectations and a strong reputation as, responding aggressively to inflation. So let me defer that a little bit to just the next part of my presentation, but I think that's exactly the question that I want you to be thinking about. At some level, the first part of our presentation is sort of exploring the question, how much did the United States, how much did central banks elsewhere in the world follow the Taylor rule in recent years? And we argue that, it looks like actual interest rates are just much smoother than the Taylor rule would prescribe. And the second part of my presentation is about, to what extent is that justified or not justified by economic theory? So that's the next thing I want to talk about.
Okay, great. And we have a second question. Maybe it's also more developed in your next slides, but the question is quite simple: are these countries also early to adopt inflation targeting?
That's a good question, which we haven't analyzed. If I had to guess, I would guess the answer is yes, but it would be great to analyze that formally. So that, I think, is one question that would be very interesting to study. And, as you probably know, if you've thought about the literature on central bank credibility, one of the challenges is how you measure these policies, because, for example, the United States, the changes that occurred around 1980, there were very important changes clearly in the reputation of the Fed and how, people saw the Fed. But at the same time, actually, they weren't legislative changes. In contrast, when I presented this work at Jackson Hole and, spoke to some of the central bankers, for example, in Africa, a lot of the changes there are legislative changes, constitutional changes. And that's a very important part of central bank credibility. So, that's another thing that's sort of a challenge here, that some of the ways of making a central bank more credible are legislative changes, and some of them are just sort of informal changes. But I think this question of what does it take, how do views change, is probably, one of the things that we take away from this work, that's just a very important question.
Yeah, I just want to add something after I will let Fred Jawadi ask his question. But when you are doing this figure of average inflation compared to change in policy, so when you are doing this average is thought without considering when they adopted inflation targeting. And the fact
Correct.
is that we know that when we adopt inflation targeting, it minimizes inflation, so it could affect this average inflation, and so the figure.
No, in some sense, that's part of what we're trying to measure. The idea is that, with inflation targeting, as I'm sure you've seen in graphs and so on, it takes a while for people to believe in it, right? And so the idea is if you've been an inflation targeter for, sort of a long time, people have seen it, they believe that it works, then they will believe that it continues to work. But if you're a country that really just adopted this very recently, it takes a while to adopt it for this credibility to develop. And you saw that in the picture I showed you of the United States that, at the beginning, maybe the Fed was talking about bringing down inflation, but they'd been talking about that for many years. And then, at some point, they really did it under Volcker. And then it still took some time before it was completely credible. And of course, that's a story in the 1980s that kind of played out around the world.
Excellent, thank you. So we have now a question from Fred Jawadi, and after a question from Philip Kleber. Fred.
Yeah, thank you. The question is about the fact when the Taylor rule does fail to reproduce the policy of the central bank. So we could ask whether is it because the two objectives included in the rule are not measured correctly, for example, the output gap, or is it because we are missing some other objective? For example, when we compare today the mandate of the ECB with the mandate of the Fed, so the mandate are a little bit different. So maybe if we try to extend the Taylor rule by including more objective, we could improve the way this rule is able to produce a policy. Or maybe finally, maybe because the model is misspecified. Because, for example, if the dynamic is said to be nonlinear, and we have a lot of up and down in the inflation, this cannot be reproduced by the rule as it is introduced in 1993. I don't know, what do you think about?
I think it's a great question, and I think all of those factors are important at different points in time. So I went back to this slide because it sort of speaks to some of the points you made. So one question is, are the variables not measured properly? And so for some periods, that's clearly very important. So in particular, I want to point out this period in the late 1970s. So this is a period when most monetary economists, I think in the United States, the traditional line about the late 1970s is that this was a period of enormous political pressure on the Federal Reserve, and that interest rates were just way too low during the late 1970s, that the Fed should have raised interest rates by more, given the rising inflation during this period. But if you look at what they said the output gap was during this period, they thought that the natural rate of unemployment was substantially below the actual unemployment rate. And so the idea through the lens of the Taylor rule is if you plug that in, if you take at face value what they say they thought the output gap was, then it kind of makes sense what their policy was. And that's a big part of the reason why using the real-time data on the output gap makes the rule fit somewhat better in some time periods, in particular the late 1970s in the United States, because you see these kind of misjudgments about the output gap. Now, one response to that is maybe this output gap measure. I mean, as we all know, the output gap is not an observable variable, right? It's a stats in some sense that the central bank takes about what is achievable. And so one viewpoint, and one thing I want to emphasize is that's not really data. It's not like the data, on employment or something in the country are being updated. It's that the policy views about what is achievable in terms of the unemployment rate are being updated. And that might reflect empirical evidence and so on, but it's different from literal data updates. Another response that people might make is, well, yes, the Fed said that the output gap was very negative, and also that the natural rate of unemployment was very low, but perhaps that was the consequence of political pressure. So that's, I think, another thing, that's tricky about looking at real-time data on the output gap. But that said, there are definitely time periods where, using the real-time data on the output gap just gives you a very different, view of the Taylor rule than using the current data, which wasn't what the Fed was looking at the time. So I think that can be very important. And the variable where it matters most, like I said, is really this output gap variable, because that's just something where views on it in the central bank often change pretty dramatically over time. The second thing you asked was about different objectives or, for example, dynamics. So that's going to be very important in the next part of what I have to say. And in particular, one thing I want to point out is that the Taylor rule has this very static quality. But if you think about things like forward guidance, so I'm going to argue forward guidance was very important in a very obvious way in a lot of countries during COVID and definitely in the United States. It just doesn't really come up in the Taylor rule, right? The Taylor rule is responding right now using the current policy rate to high inflation. But what if what you're doing is saying that you're going to raise interest rates, pretty aggressively over the next year, right? Which is actually what the Federal Reserve, for example, did. Well, that's not something that's going to show up in this Taylor rule, but if you look at models, optimal monetary policy actually does prescribe that you would use forward guidance pretty aggressively. And so that's something that's just in some fundamental sense, not part of this Taylor rule formulation. Now, again, I would emphasize that forward guidance and more complicated dynamic monetary policy rules like that really require a lot of credibility of the Fed. So, I'm going to show you that during COVID, people 100% believed what the Fed said it was going to do. The Fed had essentially complete control over longer-term interest rate expectations. So they had enormous credibility. But whether they would have had that same credibility in the 1980s, I think is very doubtful. And whether countries that have only recently moved to inflation targeting have, that kind of credibility when it comes to saying what they're going to do with interest rates over the next year or two, I think is also doubtful. So I think that that question of whether the Taylor rule sort of captures what we think is important in modern monetary policy is like a very important question. I think it doesn't capture a lot, but at the same time, I think that the context has changed where, plausibly central banks can actually do a lot more now because of this credibility that they've built up over multiple decades in the case of many of these countries. Okay, so I was talking about the COVID period, which was a period when people asked a lot of the questions that you guys were just asking because there were such huge deviations between actual interest rates and what the Taylor rule prescribed. But again, as I was emphasizing, there was also just a lot of heterogeneity. Some countries appeared to respond much more aggressively than other countries, and yet, it wasn't so clear that the countries that responded early and forcefully got so much of a payoff in terms of lower inflation. And so we're arguing that plausibly reputation was an important part of the reason for this. So to summarize what I've shown you so far, so the first part of our paper is thinking about the question of how descriptive the Taylor rule is. And what we show is that for both the United States and particularly for other countries, actual monetary policy has been much more passive in the United States than the Taylor rule would predict. And this is also true in other G7 countries. It's even more so in other G7 countries, but nevertheless, it doesn't look like inflation has taken off in a lot of these countries. So remember, I emphasized the case of Japan, for example. In addition to this, in the very recent period, in the COVID period, there was this very heterogeneous response of countries to the COVID inflation surge, which occurred around the world. A number of what we refer to as these late riser countries responded very passively, but they didn't seem to pay a big price in terms of inflation from deviating from the Taylor rule. So now I want to move on to a second question, which is very related to some of these questions that I just got from the floor, which is how prescriptive is the Taylor rule? So for example, for the kinds of very large deviations we saw from the Taylor rule during COVID, but also for the deviations that we see earlier in the sample period in the United States and in other countries, if we see a big deviation between interest rates and the Taylor rule, does this represent prima facie evidence for monetary policy being suboptimal? Does it mean necessarily that the central bank is doing something wrong from the standpoint of monetary theory? So during COVID, there were, a lot of critiques of central banks, and they sort of had this tone that if you see a deviation from the Taylor rule, the central bank must be doing something wrong. So we want to ask the question, sort of in standard models, is this true? Is it always optimal to have interest rates move more than 1-for-1 with inflation in a standard theoretical model? So to do this, what we're going to do is we're going to simulate data from a standard New Keynesian model. So this is the kind of model that a lot of central banks around the world use to think about policy. It's the model in which a lot of academics and central banks have thought about the Taylor rule. And importantly, we're going to analyze what happens when you have fluctuations in inflation that are driven by cost push shocks. So I emphasize this because when you have demand shocks, it's kind of obvious how policy should respond. So intuitively, demand shocks in a macro model, they sort of move both of the central bank's objectives in the same way. So they mean that if you have a negative demand shock, output is below the target, or unemployment is above the target, and at the same time, inflation is too low. So you can respond aggressively to both and sort of achieve both of your targets at the same time. So the economy is, overheating, you raise interest rates, and that's a very sort of straightforward prescription. But as I'm sure most of you know, cost push shocks create this much more difficult trade-off, because cost push shocks are, some kind of a shock. Let's, think about oil shocks, for example, where there's upward pressure on inflation, but simultaneously it's not coming from an overheating of the economy. So in this situation, you have this trade-off between the central bank's two objectives. So on the one hand, you raise interest rates, this will help with the inflation objective, but there's this trade-off versus the central bank's output target. So we're going to simulate this very standard model with cost push shocks, and then we're going to assume that the central bank follows optimal monetary policy with commitment. So, a lot of things are going on in the real world, but in our model, we actually know what optimal policy is. So we're going to think about what happens with optimal policy, and then we're going to ask the question. So suppose you are a researcher in this world, and you see the data coming out of the model. What if you run a Taylor rule regression just like we did? Would it look like this central bank, which we know is actually following optimal policy? Would we look like they are following optimal policy, or would we be critiquing the central bank for not following optimal policy? And we're going to adopt a pretty standard calibration of the model with persistent shocks. So the interesting thing that comes out of this, so again, very standard model with cost push shocks, and we are assuming, we know that the monetary policy is optimal, and then we run these Taylor rule regressions, just like I did in the real data a few moments ago. So here in this table, I'm showing you the results from the Taylor rule regression for several different values of the weight on the output gap. So that's, optimal monetary policy. You have to make an assumption about how much weight the central bank puts on the output gap objective versus the inflation objective. So I'm showing you several different values here. And this is not a super important point, except to say that we consider a pretty wide range of possible values. But what I want to focus on is the second column here, which is the coefficient on inflation in these Taylor rule regressions. And the point I want to emphasize is that the estimated coefficient, coming from the simulated data in this model is actually less than 1 for this pretty wide range of different weights on the output gap. And this is true, remember, even though I'm assuming that monetary policy is optimal. In fact, the coefficient on inflation is even sometimes negative. In the monetary theory literature, there is an important concept that the Taylor principle holds if a particular combination of coefficients on both the inflation variable and the output gap variable are greater than 1. I'm showing you the formula here. The last column is giving you the value of this expression. I'm not going to go through this in detail, but some of you who are familiar with these monetary models might be aware of it. But the point I want to make is that these coefficients are also 1. So, this theoretical criterion that people sometimes use for whether the central bank is following the Taylor principle is also violated here. And again, this is for the case of model-generated data, where we know that the central bank is actually following optimal monetary policy given the parameters in the economy. So what this is saying is that optimal monetary policy coming from a completely standard model actually looks like it's deviating from the Taylor principle. Okay, so this is, and this is going to be related to a lot of the things I just talked about a few moments ago about why if you have a central bank that's following optimal monetary policy with commitment, in fact, it does not prescribe that the central bank should always follow the Taylor principle in response to cost push shocks. And that's basically what this table is showing in using a simulation. So why is it that in this standard model, in fact, the central bank does deviate from the Taylor rule optimally? And again, I really want to emphasize this last table I showed you, unlike all the earlier tables in the presentation, was from a model. So, I think when you're looking at data, there are always different factors that you might not be emphasizing or you might not have been considering that could be driving the data. But when you're looking at simulation data, you really know what's driving the data. And that's what I was showing you on the last slide. So why is it that in these model simulated data, we actually see deviations from the Taylor rule? So in our paper, we kind of emphasize three standard arguments for why optimal policy with commitment can deviate from the Taylor rule. So the first is forward guidance that I've already sort of made reference to. A second is correlated shocks. And a third is long and variable lags of the effective monetary policy. So first, let me talk about the forward guidance. So I mentioned this already. As you know, forward guidance is the idea that the central bank can kind of call its shots, like a pool player, when it's setting monetary policy. So say what it's going to do before it actually does it. So this means that it's using not just actions in the sense of the policy rate, but also words to control not just the short term, but also the long-term interest rate. And the figure on the right-hand side shows how important this was during COVID. So this is the US Fed funds rate and the 2-year nominal rate. And what you see is that long before the Fed funds rate started to rise, and when it started to rise, it rose very, very rapidly. The 2-year nominal rate in the United States had already started to rise quite rapidly. And this was when the Fed started talking about the fact that it was going to start rising interest rates in the future. So in other words, the early phases of the Fed's reaction to the COVID inflation surge involved a tremendous amount of forward guidance. And the thing is that that's optimal in the kind of new Keynesian model that I presented with commitment. A central bank in a model that has the power to move interest rates not only with the current Fed funds rate, but also with announcements about future movements in the interest rates will optimally use both to control inflation. And the fact that it's using both current interest rates and statements about future interest rates to control inflation reduces the correlation between current inflation and the interest rate. So that's one of the things that drives down the coefficient in the Taylor rule, because it's not just a response of current interest rates to current inflation, but also sort of a response of statements about future interest rates and then a playing out of the consequence of those statements about future interest rates also being used to control inflation. And that's optimal in the model, and something that I would argue was also quite important in the world in response to COVID. But this means that the two movements, inflation and interest rates, don't necessarily happen simultaneously. So, there's a big inflation surge. In this episode, people anticipated that the Fed would respond, but they didn't do it right away. And this is something that can lead to Taylor rule violations. A second thing that can lead to Taylor rule violations is just correlated shocks. So in these models, sometimes central banks will sort of simulate these models with uncorrelated shocks. That's, in fact, the typical assumption to make, cost push shocks that are uncorrelated. But a recession like COVID saw not only traditional demand and supply shocks, but it also saw an increase in fear and uncertainty. which may have led to an increased desire to save. So in the early period of COVID, people really didn't know what was going to happen. And during this period of time, perhaps people said, well, we might need to save for potentially a long recession. There were also other kinds of shocks that happened at the same time. For example, there was a big change in people's preferences for buying goods versus services. There was a big increase in the preference for goods versus services because people were worried about buying services because of, worry about exposure to disease and so on. And, the simple model that I presented didn't have either of these things, either correlated shocks or multiple sectors. But in the paper, we think about the scenario of correlated shocks. And this is something that can imply, deviations from the Taylor principle. It's very intuitive. If the natural rate declines at the same time that you have a cost push shock, and I think it's something that's plausible for the COVID episode, then this is something that can also lead the central bank to optimally not want to raise interest rates as aggressively. So intuitively, the central bank is trying to track the natural rate. If the natural rate falls at the same time that there's this cost push shock, then naturally that means that the central bank doesn't want to raise interest rates as aggressively. On the issue of a multi-sector model where you could have preferences over goods versus services. So this is a more complicated model, but in a lot of these models, people have shown that that in a multi-sector model with shocks to preferences over one sector versus another, this can look like a cost push shock. So there were a lot of these different shocks that were occurring at the same time, and some kinds of correlations can also lead to deviations from the Taylor rule. Okay, a third reason that you might see deviations from the Taylor rule is, a very long-standing idea in the monetary economics literature, which is long and variable lags. So suppose that the central bank expects the shock, like say an oil shock or some other kind of cost push shock, to subside very quickly. But it also believes, and this is of course the standard view in monetary economics, that monetary policy will take some time to have an effect on the economy. Then the central bank might believe that even if it does raise interest rates, the interest rates won't be able to actually affect inflation, for at least 6 months to a year. And that by this point in time, perhaps the shock itself will have already gone away. So in this case, the central bank, there's sort of no point in raising interest rates because the horizon at which the interest rates will affect the economy is already beyond the horizon at which the shocks will have subsided. So this is a very intuitive idea. You often hear it being discussed. It's actually surprisingly hard to model it formally. So monetary economists have a lot of models in which lagged expectations of interest rates affect the economy, but it's harder to develop a model in which it's actually lagged interest rates themselves that affect the economy. But it's a very intuitive idea, goes back definitely all the way to Milton Friedman. And, in recent work, Barnishon and Mesters, they've been kind of using this type of idea in the context of analyzing optimal monetary policy. I would argue that this was particularly important as something that influenced central bank thinking during COVID. So historically, inflation and one-year ahead inflation expectations have moved together almost one for one. So here, this is what I'm showing you. The red line is 1 year ahead inflation forecast from the survey of professional forecasters, and the blue line is actual core inflation. You can see that until, very recently, these two lines lie almost entirely on top of each other. So in other words, current inflation and 1 year ahead inflation expectations, which is typically something we see as a pretty short-term forecast, are just almost the same variable. But during COVID, the inflation surge, for the first time, you see this massive gap that actually opened up between the two. So in other words, professional forecasters during COVID, basically for the first time, they thought that even though inflation was, over 5 percentage points now, they thought that it would go back, to something like 2% within a year. So they thought that inflation would be very transitory. And this was, as you see, very unusual in US history, but clearly was an important part of why the Fed responded the way it did. Now, as we know, there's been a big discussion of this in the aftermath of COVID. Inflation was much more persistent than private sector forecasters and the Fed thought it would be at the time. But in the longer span of history, it still came down pretty quickly. I mean, clearly, inflation didn't come down within the year. So in that sense, these expectations of transitory inflation were overblown, but it did come down in a horizon of several years. So to sum up, there are at least 3 reasons for monetary policy to be more passive than the Taylor rule predicts, even in the model. The first is forward guidance. The second is correlated shocks to the natural rate that happen at the same time as cost plus shocks. And the third is the delayed effects of monetary policy. But at the same time, we actually, haven't seen a lot of analysis of deviations from the Taylor principle in monetary theory. So why is this? Why isn't there more analysis of this case, given that it seems that a lot of central banks are actually doing this, and that it doesn't look like inflation has gotten out of control, despite monetary policy looking a lot more passive than the Taylor principle would predict. And given that it seems to come out of a fairly standard analysis of optimal monetary policy with commitment. Well, one of the main reasons we think for this in the academic literature has been the concern over local indeterminacy associated with not following the Taylor principle. So the worry in the literature is that local indeterminacy could lead inflation to behave in an erratic fashion, and that local indeterminacy is specifically a problem that arises in the context of violating the Taylor principle. So here I want to make sure to just mention the distinction between local indeterminacy issues, which is the issue that the Taylor principle potentially can solve, and global indeterminacy concerns where fiscal policy is the standard response and which are really distinct from local indeterminacy concerns. So, we argue that these local indeterminacy concerns are an important part of the reason why the academic monetary economics literature is sort of shied away from analyzing policy rules that violate the Taylor principle. So then it becomes an important question. How important are these local indeterminacy concerns from a practical standpoint? And we argue that these local indeterminacy concerns are, plausibly really overstated in the academic literature relative to what we think is their sort of appropriate level of importance. And we argue this for 2 reasons. First of all, there are some very standard other ways of avoiding indeterminacy aside from the Taylor principle. So one of the things that we discussed in the paper is the notion of what we call a minimalist Taylor principle. The idea is that even if you're not always responding aggressively on the equilibrium path to deviations of inflation from your target, as we showed that central banks often aren't, you can potentially commit to respond very aggressively to non-fundamental shocks, even without tying your hands with respect to these observable cost push shocks. And this might allow you to get closer to optimal monetary policy. Second of all, we emphasize that the local indeterminacy concern is very sensitive to what we would call sort of small deviations from hyper-rational models, in which people are very forward-looking. So these are, of course, the standard models that people are using in the monetary economics literature. But the assumption that people are so incredibly rational about the future turns out to be very important in terms of this local indeterminacy concern. And even when you sort of deviate epsilon away from that assumption, it turns out that this local indeterminacy concern really falls apart. Okay, so let me talk briefly about these 2 arguments. The first argument is sort of technical, so I'm not going to go into the details. But the basic idea, for those of you who may have, solved some of these models, is that for any monetary policy rule in a monetary model, even one that doesn't satisfy the Taylor principle, you can always calculate the minimum state variable solution to the model, where you're assuming that the economy is only responding to fundamental shocks. And then what you can do in the monetary policy rule is you can just take the the monetary policy rule, and you can tag on an additional term that says that the central bank will respond aggressively to inflation that deviates from this minimum state variable solution. So you can have whatever policy you want on the equilibrium path, but then you're adding this additional term that says that the central bank will respond very aggressively to deviations of inflation from this fundamental path. So in other words, if there are non-fundamental shocks that are influencing inflation, that the central bank would respond aggressively to that. And this policy alone, even in what we're referring to as a pretty hyper-rational model, will rule out local indeterminacy. The upside of this is that if you add this off equilibrium response, then the central bank can actually do whatever it wants on equilibrium. So for example, it might be optimal from the perspective of the model to respond very little to a cost push shock for the reasons I was describing earlier. And with this kind of policy rule, that's totally feasible for the central bank to do without worrying about this local indeterminacy concern. Now, one very reasonable concern is, how would you ever convince people that you're going to respond aggressively to off equilibrium inflation, unless you respond aggressively on the equilibrium path? I think that's a very reasonable concern. But perhaps there are some times when you think that the shock is obvious enough. Maybe COVID was one example of that. Was obvious enough that it wasn't a non-fundamental shock, that the central bank might be able to identify those shocks, respond less aggressively to them, and still maintain a reputation for inflation fighting. And arguably, that's what a number of central banks around the world, including the Fed, actually did during COVID. So clearly this depends a lot on reputation, but perhaps there are times when the central bank has built up enough reputation to be able to do that. Okay, the second argument we make for why these local indeterminacy concerns might be overstated in the literature is that they depend crucially on what we call hyper-rational behavior by the people in the model. So why is that? Well, the local indeterminacy concern arises because agents today believe that agents arbitrarily far in the future will continue to respond to today's non-fundamental sunspot shock. But of course, that logic implies that we today should still be responding to sunspots that occurred long ago, during the French Revolution. And there's an obvious question as to how reasonable that really is. And it turns out these models are very sensitive to even very small deviations from this assumption. So an example of a very small deviation along this line is this paper by Mike Woodford in 2018, where he analyzes what he calls a finite planning horizon model. So in this model, people plan a finite number of periods into the future, but this finite number of periods can be very large. So they can be planning really far into the future, as long as it's a finite number of periods into the future. And as long as it's finite, then these local indeterminacy problems disappear. So, you can see this sensitivity when I say that they can plan really far into the future, any finite number of periods, and that's enough for the local indeterminacy problem to sort of fall apart. And another example of a recent model that kills this kind of indeterminacy concern is this paper by my colleague Chen Lian and Marios Angeletos. In this model, they assume that people are slightly forgetful about sunspots that occurred in the past, and this is another small deviation that can lead this local indeterminacy concern to go away. So to sort of summarize, we argue that in some very reasonable and small deviations from these hyper-rational models, these local indeterminacy problems just aren't important. Now, perhaps you're thinking there must be something wrong with this argument, because there's this very reasonable concern that arises associated with inflation spirals when the Taylor principle doesn't hold. So what is that concern? Well, this goes all the way back to Wicksell and Friedman. The argument is simply that if inflation rises and the nominal interest rate rises less than 1 for 1, then the real interest rate is going to fall. And if the real interest rate falls in response to higher inflation, then this boosts demand, inflation raises further, And there's this feedback loop that potentially can lead inflation to spiral out of control. So this seems like a big concern of deviating from the Taylor rule. But what I want to emphasize is that this concern is really about expectations being unhinged. And this isn't the local indeterminacy problem at all. In fact, this kind of inflation spiral turns out to not occur in the new Keynesian model, even if the Taylor principle is violated. And the reason is that the standard new Keynesian models that central banks often use assume that people believe in the inflation target of the central bank. So, there was a question earlier about inflation targeting. In these models, we often assume that there's just complete credibility about the inflation target. And once you assume that, then the economy will return to steady state, even if the Taylor principle doesn't hold. So the local determinacy problem that arises and is potentially addressed by the Taylor principle is just completely separate from this inflation spiral problem. And in fact, even if the Taylor principle is violated, and there is this local indeterminacy problem, this inflation spiral doesn't arise because typically in these models, people are assuming that there's complete credibility of the inflation target. So I think this is an important deficit that we would argue is, much more important than the local indeterminacy problem. Imperfect credibility often isn't included in the standard models that central banks use, and inflation expectations are typically assumed to be completely anchored. And this is really what rules out inflation spirals, not the Taylor principle. So in this finite planning horizon model of Woodford in 2018, one of the things he introduces is imperfect anchoring of inflation expectations as a way of reintroducing the inflation spiral idea. And, this is something that I think from a practical standpoint is potentially very important. And of course, there are other papers as well that have analyzed imperfect commitment to the inflation target, imperfect credibility. And we would argue this is an important sort of direction of research and much more important than this local indeterminacy concern. And entirely separate, something that's not addressed either way by the Taylor principle. So the last thing I want to discuss on this point is perhaps the elephant in this room, which is reputation. So as I just emphasized, many of the theoretical models that central banks around the world use take as given beliefs about the inflation target and also the central bank's reputation for inflation fighting. And during the COVID inflation surge, these were incredibly important. The top graph is what I showed you before. So you see that the 2-year nominal rate started to rise substantially before the policy rate. And in this sense, the central bank, the Fed was able to benefit a lot from reputation because people believed that it could call its shots. And this allowed it to use forward guidance. And below, I'm showing you the real interest rate, the 5-year inflation-adjusted TIPS rate. And here you see that the Fed during this period also benefited from anchored expectations because the real interest rate 5 years ahead rose almost 1-for-1 with nominal yields. Why was that possible? It was possible because inflation expectations were so anchored. So inflation expectations had been rising during this period, then they could have raised the nominal rate, but the real rate would have risen by much less. It's sort of easy to forget how remarkable it is that various central banks around the world, including the Fed, were able to look through 7 to 8% inflation without unhinging inflation expectations. And clearly, this requires a very strong reputation, which the Fed probably didn't have when Taylor wrote his paper in 1993, but clearly had acquired by 2020. When they used it during the COVID inflation surge, did this dramatic forward guidance and real interest rates rose so dramatically because inflation expectations were so anchored. And it's, of course, not as clear today, and this is, part of the policy debate that we have today, whether this will be possible again in the face of another cost push shock, given the very recent experience of high inflation. So to sum up, in our paper, we ask 2 questions. The first is, how descriptive is the Taylor rule? And we find that even the best fitting versions of the Taylor rule don't fit particularly well over the past 20 years, particularly for countries other than the United States. On the question of how prescriptive the Taylor rule is, we point out that even very standard monetary theories actually support the central bank deviating from the Taylor principle in various cases. But it's important to acknowledge that the theory that we're relying on, which is analyzing the consequences of monetary policy with commitment, assumes implicitly well-anchored inflation expectations and that the central bank has a very strong inflation-fighting reputation. So one of the rules that I talked about, assumed that people believed that the Fed would respond aggressively, for example, to non-fundamental shocks to inflation. And so these are really important assumptions. And to sum up the message from the theoretical part of our paper, we asked the question, can you go beyond the Taylor rule and still be following policy justified by monetary theory? The answer is clearly yes, if you focus on optimal monetary policy with commitment. But what is really critical for this is market confidence that the central bank will act aggressively in response to deanchoring, because that's assumed in the model. And of course, in the real world, this credibility depends on institutions like central bank independence and a long track record of something like inflation targeting. And plausibly, those are things that take decades to build up and perhaps not very much time to destroy. Okay, let me stop there and see if there are any more questions.
Excellent. Thank you very much, Emi, for this fantastic presentation. So now we will open the questions from the attendees. So please raise your hand and we will allow you to ask your questions. So we will start with Yossi Achin from the Bank of Israel.
Okay, thank you. Thank you for this presentation. Very interesting. My question is about the simulation of the model. And I was wondering, if I remember correctly, I hope I'm not misrepresenting the results, the theoretical results of optimal policy under commitment. If I remember correctly, under commitment,
correct, absolutely.
Interest rates are smoother than the optimal policy under discretion. So that may give motivation for interest rate smoothing. And then I was wondering what happens if you estimate the Taylor rules allowing for interest rate smoothing. Then the coefficient of inflation is also multiple. So the overall coefficient that also is multiplied by 1 minus the smoothing coefficient can be smaller. Anyway, my point is, you may, once allowing for interest rate smoothing, you may find out that the Taylor principle holds in the simulations. So my understanding. So I was wondering what happens in this simulation if you did this exercise.
Yeah, it's a good question. And actually, we didn't do it in the simulations. We did do it in the data. So in the appendix of our paper, we also analyze rules, because that's something people have done in the empirical literature as well, where you allow for interest rate smoothing, and you're looking at sort of like a target interest rate and whether that responds aggressively to inflation or not. And in that case, it's true, it's more variable, sort of the conclusions about whether the Taylor principle holds across countries. And in some countries it holds, in other countries it doesn't hold. For the United States, the conclusions are relatively similar to what I presented. But in that case, one of the things to emphasize is just kind of, echoing what you said about the importance of credibility at the beginning. In that case, what you would conclude by looking at the data is that even though you don't see any aggressive response of the central bank in the short run, that you believe that the central bank is sort of asymptoting towards some very aggressive response in the long run. And from what I showed you, you can see that to have that type of rule fit well, you need to have a very slow response. of interest rates in terms of converging to the target rate. So one of the things that I want to mention sort of as a side point is sometimes you'll see empirical work, which is emphasizing the fit of the Taylor rule with these interest rate smoothing rules. But the graph they're actually showing is the fitted value from a rule in which one of the predictors is the lagged interest rate. And you see a very good fit, but almost all of the fit is just coming from the lagged interest rate, you know? And so the evidence for the view that in fact the central bank is responding very aggressively in terms of the target interest rate is always going to be harder to get, you know, because if you're in a model where you're never at the target and you're asymptoting very slowly to the target, it's harder to see. But I think it would be interesting to do it in the model. That's not something that we did. And I think you're right that there's, you know, a strong parallel between that type of a belief and, you know, the type of things you get out of you know, optimal policy with commitment.
Okay, great. Thank you.
So I said thank you for your question, Yossi. So now the floor to Osnat Zohar from the Bank of Israel too.
Let me also thank you for a very interesting presentation, really bridging between theory and practice. I also wanted to comment about model simulations. And I fully agree with your point that commitment may lead to a smaller estimated coefficient on the Taylor rule, but I just wanted to mention that these models assume a very strong form of credibility. And so commitment in these models will be for the central bank to act aggressively from now onward, even 1,000 years from now. And agents in the model find this commitment very credible. So even in response to a positive cost push shock, they will expect inflation and output to be much lower in the future. So these expectations will lower inflation today, and the central bank may find it optimal to lower rates today, which is very counterintuitive, right?
Mm-hmm.
So just to note this extreme credibility that is in the background, but I do agree that in general, it will contribute to a smaller response needed for.
Yeah, I completely agree with you. You know, I kind of emphasize some of these issues related to credibility, but I think you're also absolutely right that you know, there's this recent literature on the forward guidance you know, puzzle in the monetary economics literature. In the models, the response to far future interest rate changes is just very large. And so this leads to some things that are intuitive. This is kind of what I was emphasizing. You know, I think the central banks really do use forward guidance, and there's some intuitive aspects of this. But then there are some things, you know, for people who've worked with these models that are not intuitive, because the responsiveness to far future, you know, interest rate movements is just so large, and you get sort of, there's some weird stuff that happens in the models as a consequence. I'm very sympathetic to that. I think actually some of the work on the forward guidance problem has also contemplated models in which there's some discounting of response to far future interest rates. I think that might be one direction that would be interesting to consider, to have, you know, think about the robustness of some of these less intuitive predictions about the behavior of interest rates as a consequence of this kind of strong form of commitment and response to very aggressive response to the economy to very far in the future interest rate changes. And I think those are sort of interesting directions for research. So, you know, so anyway, I agree both with the idea that there's some things that are sort of strange about the forward guidance in these models, and also that I think there's this very practical and actually very intuitive aspect that all of this depends a lot on credibility, and that you can't take it as given. And clearly, you know, probably no central bank in the world had this kind of credibility in the 1980s. Some central banks probably have it now, but the credibility has also probably been eroded by the very high inflation that we've seen over the past 5 years, you know, in many countries around the world, and it's not clear they could do it again. So I think both of those points are important.
Thank you very much, Osnat, for your question. Now we have a question from Lassen Bunader. Lassen.
Okay, thanks, Jonathan, and thanks, Emi, for this really provocative paper. So I have first question on the same issue that was raised by the two colleagues. So first on the estimation of the optimal commitment. So when you estimate the optimal commitment, so is it easy to pin down the Taylor coefficient? And this reminds me of the paper of John Cochrane, the GPE 2011, where he sees the optimal commitment as, or the Taylor principle as a deterrent. So you cannot observe it from the data that you generate following the optimal commitment simulation. So that's the first one. So second issue, or the second confusion I have is the argument two that you raised on the hyper-rational expectations models. So basically, the tension that you generate is based on the NK, the Neo-Keynesian model, which is also hyper-rational in a sense. So I find it a bit difficult to understand the argument too. And on the inflation spirals, so the inflation spirals also rest on the fact that there is rational expectations, and inflation is anchored. Inflation expectations are anchored. So I find like a little bit of tension between the use of rational expectations on one hand as to blame for the Taylor principle power, and on the second hand, to use the rational expectations as a way to avoid the inflation spirals.
That's very interesting points. On the first question, I think that the question you're asking is very closely related to what we refer to as a minimalist Taylor principle in our paper. So the idea there is that to achieve, to address local indeterminacy, and this is not, a new idea. I think Jordi Galli actually has it in his book. It's not necessary to follow the Taylor principle all the time. So that's how it's almost always used in practical kind of optimal monetary policy analysis. So if you look at, practical analysis of optimal monetary policy and central banking kind of works, what they typically do will be to only analyze optimal monetary policy for a space of monetary policy rules for which the Taylor principle holds, meaning on equilibrium and off equilibrium. And the point we make is that you can actually separate those two things. The local indeterminacy problem, even in the hyper-rational model, will be fully addressed by only responding off equilibrium. And that's sufficient. Now, as I said in the presentation, there's a separate question as to how you acquire and maintain the reputation for that kind of off equilibrium play, but it works as a theoretical matter. And the advantage of what we call the minimalist Taylor principle is the fact that if you are able to commit to this strong off equilibrium response, then you don't have to, in some sense, distort your on equilibrium play. So you can choose to respond less aggressively, for example, to cost push shocks, that you can observe, and still not worry about this local indeterminacy problem. So that's the advantage of this minimalist Taylor principle, as opposed to assuming that Taylor principle holds both on and off equilibrium. So that's what I would say about the first point, that I'm totally sympathetic to the view that what's important in the hyper-rational model is the off equilibrium play, and that's actually sufficient. And that's important because it means that a central bank can reasonably consider and analyze on equilibrium play, which doesn't follow the Taylor principle, and that you don't have to, worry that you're going to end up with this local indeterminacy problem. On the inflation spirals point, the context in which that arises is actually the context in which, you're right that the inflation spirals point, what I want to emphasize is that it arises in the context of imperfect credibility. It's really like a separate vector of issues. So what I want to emphasize about local indeterminacy and rationality is that it depends very much on not just people being forward-looking, but people being infinitely forward-looking. And if you sort of cut off the chain of beliefs at any point in the future, even really far in the future, just not infinitely far in the future, then the whole thing falls apart. So in some sense, it's very, it's very sensitive. The local indeterminacy concern is this very specific concern about the idea that, if I believe inflation, is going to be higher, and you believe that I believe, and we all believe in this, for the infinite future, then we can sustain a response to sunspot shocks, completely unrelated to anything that's actually happening in the world. And that's the concern about the local indeterminacy. But actually, those kinds of local indeterminacy concerns, they're actually mean reverting. So it's not a problem of inflation spiraling out of control. It's more a problem that just all of a sudden, everybody will think something different and inflation will just jump. That's sort of the thing that arises with these local indeterminacy concerns. But it's still mean reverting. You'll eventually end up back at the central bank's inflation target, but you'll just have these fluctuations that have to do with the sunspot shocks. But there's this other concern, which doesn't arise if you assume that the central bank's inflation target is completely credible, which relates to the notion that maybe people just don't believe that the central bank is going to achieve its inflation target. And in particular, you think about a shock like COVID, where inflation, gets to say 8 or 10% or something like that in some countries. If the central bank doesn't do anything, and the reputation for inflation targeting is not so ingrained, then what's to stop people from just starting to think, well, maybe the central bank isn't really committed to this inflation target anymore? That's the concern that the inflation spirals literature is really about. But that concern often isn't included in the standard Keynesian model, even when it's assumed that the Taylor principle holds, because often the standard model is assuming that there's complete credibility in the monetary rule.
Thank you, Nassim, for your questions. Sorry. So now we have a question from Fred Jawadi.
Yeah, thank you. In the model, you suppose that the fluctuations are driven by cost push shocks, right? And then while doing so you conclude that the standard theory could help to justify the deviation from the rule. And my question is whether this assumption is required as a condition. What if the fluctuations are driven by another kind of shock? It is now more like a demand shock. What happened, for example, in the aftermath of the COVID, because the recovery were rapid, people were asking for demanding more and more. So this demand shock, push inflation to get up. So does the conclusion still hold if we have another class of shock? Thank you.
No, it's very sensitive to that. So with a demand shock in these models, there really isn't a trade-off. So, with a demand shock in these, at least in these simple models, the central bank can, raise interest. So if there's a negative demand shock, so if COVID was just that everybody, got worried about the economy and stopped buying things, then the central bank sort of has a perfect path of response. It lowers interest rates, it makes people buy more things, and that also pushes inflation back up to target. And so there really isn't any trade-off, and there's no reason. In fact, so in that case, actually, optimal monetary policy says that the coefficient on inflation should be infinite. Okay, so the deviation actually between optimal monetary policy and actual central banking practice is in the opposite direction. The central bank should be infinitely responsive to any deviation of inflation from target, and that's what's optimal in the model. So, but it's not optimal to not respond. It's in that model, you should never see any deviations from target if the central bank is behaving optimally. So there is a very big difference, and I think that's clearly another important factor here is is the shock in question? Is it a demand shock? Is it is it a cost push shock? I also talked about the question of natural rate shocks that might be occurring at the same time. And, another challenge that I didn't emphasize, but which is clearly very important, is how would a central bank, distinguish among these shocks? So if you think that every shock might be a demand shock, then maybe you should respond very aggressively. But perhaps there are some shocks, like say oil shocks or COVID, where you can argue that you have a pretty good reason to think that, there's a part of it that's a supply shock, right? Or an oil shock or something like that. And I think this is a big part of what central banks do, right? They spend a lot of time trying to talk about what shock it is. And that's important for this reason, because if you think every shock is very likely to be a demand shock, then it's absolutely right that there isn't the kind of trade-off that I've been analyzing. And so the kind of trade-off I've been analyzing is really pertinent to the case where there's this tension between the central bank's different objectives.
Okay, thank you.
Thank you, Fred, for the question. Now we have one last question from Evangelos Travelas.
Okay, thank you. A remark and a question from my side. Emi, the minimalist Taylor principle achieved determinacy through an off-equilibrium commitment that by construction is never exercised on the equilibrium path, making it observably equivalent to not having it. The policy conclusion then rests entirely on credibility. But if the channel through which credibility reaches agents has a serious structure, where each institutional dimension is a necessary link, then the credibility is the product of those dimensions, not the sum. Any single failure collapses the anchor to zero, and no reaction function design is governist. The question then isn't which rule restores determinacy, it's whether the transmission architecture capable of carrying any rule to agents is intact in the first place. My question is, does the framework have anything to say about that prior constraint, or is the channel's integrity taken as given throughout?
So first of all, let me just say, I think that's, it's a very important concern, absolutely, as I said, why would, if you never see the central bank responding to inflation, why would you believe that it will in this scenario off the equilibrium path? And we think that perhaps that's part of what's going on, right? In a period like, I emphasized during the COVID inflation, there was this big gap between what countries did who had had this long history of low and stable inflation versus countries that had more recent experiences of high inflation. One way to think about it, I think, in practical terms, is that perhaps it makes a lot of sense that the default response of the central bank to high inflation should be to raise interest rates, and that's partly about the credibility issues that you mentioned, and the fact that, as we just discussed, the optimal response of a central bank to demand-induced inflation is actually infinity, but that there might be some cases where you can deviate from that. That there might be some cases where credibility is strong enough, right? And this is probably context dependent and depends on the history of the central bank, and belief about the nature of the shock is strong enough that it's possible to deviate from this rule without completely destroying the reputation for responding aggressively to inflation. So I think that's one way of thinking about it. Does our model say anything interesting about how reputation forms and how a central bank loses reputation? No, it doesn't. And I think that's an area where a lot of work has been done. The formation of reputation about credibility for the central bank's inflation target, but where we would argue perhaps even more emphasis is needed. So at some level, what we're trying to do in our paper is shift the balance of attention in some sense from the question of local indeterminacy, for example, and the Taylor principle in the direction of more emphasis on credibility, because we would argue that from a practical standpoint, that's probably where the most important problems lie.
Okay, thank you very much, Evangelos, for your question, and of course, Emi, for all your deep replies. So I will not extend this seminar because we are a bit above the time, but I just have my regular question, and I will ask my deeper question directly by mail. But I have this question about, okay, so we have this paper and we are a central banker. What should we take from it? Could we just, this is my interpretation, but of course, correct me, I'm sure I'm wrong. Should we just abandon the Taylor rule and just search for a new, better monetary policy interest rule? It could be nominal GDP targeting, it could be something else, but at the end, we want something that matches our decision, or for credibility reasons, by the way. Or should we keep it for also reputational and credibility in the sense for the public that they have to understand us? So yes, how do you see that if you are a governor of a central bank and you have this paper in hand?
So the way I would see it is that it depends on the strength of credibility. I think what we've seen over the past 20 years is that a lot of countries have been able to deviate from the Taylor rule over very sustained periods of time without, destroying their credibility. Far from it. So that is possible. At the same time, we know that this isn't, almost the majority of countries in the world have severe inflation problems. So, the subset of countries that I talked about as late risers who were, in some cases undershooting their inflation targets while, remaining very, very passive in monetary policy is probably a minority of cases. So I guess what I would emphasize is I think it is possible, but it depends heavily on credibility. And so I think the answer to that question is context dependent. I would say that conditional on very high degree of credibility and reputation as an inflation fighter, then it's possible, and optimal from the standpoint of theory to deviate from, the Taylor rule on occasion when, you have a strong sense of what the shock is. These are a lot of things that we've talked about a lot. So when you have a strong sense that this is a cost push shock, this is not non-fundamental inflation, this is not demand-driven inflation, then there are good theoretical reasons for why you would want to deviate from the Taylor principle. If you think you can keep credibility under control, but thinking about measures of how strong credibility is going to be important, and I think that's, one of the big discussions that's happening now, because I have no doubt that credibility has been eroded by very recent experience of inflation. So, this is obviously a somewhat unsatisfying answer in that it doesn't give you one number like the Taylor rule does. But I think it's also an expansion of freedom, and clearly, this is already part of the practical conduct of monetary policy that that countries deviated, a huge amount from the Taylor principle during the COVID inflation surge. And so I think clearly, even in terms of revealed preferences, there's a lot of evidence that, central banks want to consider a more diverse set of responses, at least to shocks where they think they can credibly say that these are, largely cost push as opposed to demand shocks. And, what we're sort of showing is that that's actually completely consistent with theory.
Thank you very much. So I just want to add something about what you said, but we will end this seminar because I understand it's a long one and very, very interesting. But when he said, okay, so the credibility was affected by high inflation from the past or recent ones, it was also changed. I will not say affected because it's already a position. But it was changed also by the change into the Federal Reserve, for instance, that changed its perception of inflation and what is inflation for the Fed, and also when central banks change mandates and stuff like that. So the question could be now: is it because we had this high inflation period that we changed mandates and objectives?
Yes, that's a good. I think that's a very. Are there political cycles? I hope not.
Yes. Great. Okay, so thank you very much again for all your seminar presentation paper and your deep replies. We are very glad to have you now, and we hope to have you for your next policy relevant papers. And I know you have a lot. Thank you very much.
Okay, thank you. Bye-bye.
Have a nice day. Bye-bye.